Hey everyone, and welcome to this explainer. Today we're diving into one of the absolute most critical updates in the Income Tax Act 2025. We're talking about Chapter 13A. Now, whether you're a seasoned chartered accountant, a CS student cramming for exams, a tax pro, or a business owner, understanding how tax is calculated in these special cases under the new regime is just non-negotiable. We're going to break down sections 190 through 195, which covers everything from calculating non-taxable income to those really heavy, punitive taxes the department slaps on unexplained cash credits. Here is our roadmap for today. We'll start with an introduction to special cases, then decode the legal provisions, walk through a practical taxation example, cover navigating compliance requirements, look at common issues and pitfalls, and wrap it all up with a summary and key takeaways. Okay, picture this. It's a very real, practical situation. A business owner is undergoing a survey by the department and, bam, they find unexplained cash or some unrecorded investments. So what actually happens under the new 2025 law? Does that money just get lumped into their regular business income and taxed at the normal friendly slab rates? Well, absolutely not. The real answer is much more severe, and it's exactly what we're going to unpack right now. All right, let's jump straight into Section 1, Introduction to Special Cases. Think of Chapter 13A like a giant override switch in the tax code. The minute an assessee's income triggers sections 190 to 195, you can toss the standard slab rates right out the window, at least for that specific chunk of income. The whole point of this chapter is to make sure that these special incomes are completely ring-fenced, whether we're talking about globally traded receipts, a lucky lottery win, or, on the darker side, penalized undisclosed income. This chapter ensures they get hit with their own specific tax rates, totally separate from the taxpayer's regular income bracket. Moving right along to Section 2, Decoding the Legal Provisions. Let's see what these sections actually say. We'll kick things off with Section 190. This one is really just about fairness. If your total income happens to include parts where no income tax is payable under the Act, this section steps in to provide some relief. It essentially allows a deduction from your overall tax liability equal to the tax calculated at the average rate on that non-taxable portion. It's just a mathematically fair way to make sure you aren't accidentally paying tax on exempt income simply because it pushed your overall slab higher. Next up, we have Sections 193 and 194, and these guys create very specific tax buckets. Section 193 is tailor-made for resident employees in knowledge-based industries who deal with global depository receipts, GDRs, bought in foreign currency. On the flip side, Section 194 takes care of casual incomes. We're talking lottery winnings, crossword puzzles, that kind of thing. It applies specific, aggregate rates straight from the statutory table, and it completely ignores whatever your normal salary or business income happens to be. Now, for all the tax professionals listening who are frantically trying to map the old law to the new one, pay close attention to this. Based on the new transition FAQs, here is the critical shift. Under the old 1961 Act, we had sections 115 BBE and 158 BC. Well, those have been reincarnated in the 2025 Act as sections 195 and 192. So Section 195 is your new home for unexplained cash credits and investments, which, by the way, are now detailed in Sections 102 to 106. Meanwhile, Section 192 is what handles the total undisclosed income of a block period found during a search and seizure. And that brings us to the most crucial takeaway here, 60%. This is the punitive base rate, and it is huge. A flat 60% base rate applies to the total undisclosed income of a block period under Section 192. And it's the exact same story under Section 185 for unexplained investments or cash credits, a flat 60%. But wait, it gets worse, because that's just the base rate. The law says this tax gets bumped up even further by any applicable surcharges. It is literally designed to be a massive deterrent against tax evasion. Okay, Section 3, a practical taxation example. Let's see how this actually works with some numbers. Let's say you have a client with 10 lakh rupees of totally normal, regular business profit, but during an assessment, the officer uncovers 5 lakh rupees of unexplained cash credits. Step 1, you have to segregate them. You literally cannot mix these two pots of money. Step 2, that 10 lakh of regular business income gets taxed normally, using the standard slab rates. But Step 3, that 5 lakh of unexplained cash triggers Sections 102 to 106, which drops it right into Section 1095. It gets hit instantly with that flat 60% base rate plus surcharges. And no, they do not get to use any basic exemption limits against that 5 lakh. It's a hard, flat penalty. Next, Section 4. Navigating compliance requirements. How do you keep the tax portal happy? Look, compliance under the 2025 Act is completely system-driven now. The recent guidance notes make this super clear. You have to drop the old terminology immediately. We are exclusively using the term tax year now, not assessment year or previous year. And when you're filing audit forms or 2DS returns, if you quote the old Section 115 BBE instead of the new Section 195, the portal's system validation will just automatically reject it. Plus, every single official communication now absolutely requires electronic authentication using a system-generated DIN, or document identification number.
Let's move over to Section 5 and talk about common issues and pitfalls.
This is a massive trap, folks, and it closely mirrors the old Section 79A principles. The 2025 Act strictly prohibits you from setting off brought forward losses or unabsorbed depreciation against undisclosed income found during a search. Let's say your client has 20 lakhs in brought forward business losses sitting on the books, and the taxman finds 10 lakhs of unexplained cash under Section 195. You cannot just use those past losses to wipe out the unexplained cash. That 10 lakhs will be taxed at 60%, regardless of how badly the overall business is bleeding money.
All right, we made it to Section 6, Summary and Key Takeaways. Let's lock this in.
To wrap it all up, Sections 192 and 195 are your new punitive heavy hitters. They replace 158 BC and 115 BBE, and they carry a massive 60% base rate. Remember, you absolutely cannot shield this undisclosed income using old business losses. And finally, make sure your entire firm is retrained to use the phrase tax year and the correct 2025 section codes so you don't get snagged by portal rejections. So, I leave you with this thought. With these punitive 60% rates now strictly enforced under the new regime, is your client's documentation truly robust enough to withstand a 2025 assessment? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.